You open your phone, you check the news. Another headline about national debt. The US owes $35 trillion. Japan owes $14 trillion. China owes $13 trillion. Germany, France, Britain, all drowning in red ink. You do the math in your head. If everyone owes money, someone must be owed money. That's how debt works. For every borrower, there's a lender. For every debtor, a creditor. So you ask the obvious question, who's getting paid? The answer you'll find isn't just surprising. It rewrites everything you thought you knew about money. Global debt stands at $307 trillion as of 2024. That number includes governments, corporations, and households. The entire global economy, every good and service produced on Earth in a year, totals around $105 trillion. The debt is 3 times larger than the entire economy. That's not a crisis. That's a structural impossibility masquerading as normalcy. Most people assume the creditor is China, or oil-rich Gulf states, or shadowy bankers in Switzerland. The story goes that responsible nations lend to irresponsible ones. Savers, finance spenders, creditor countries own debtor countries. That story is a lie. Not a misunderstanding, a lie. And it's a lie that hides the most important economic mechanism in your world. China holds $859 billion in U.S. Treasury bonds. Sounds massive. But against $35 trillion in total U.S. debt, that's 2.4%. Japan holds slightly more at $1.1 trillion, still only 3.1%. All foreign nations combined hold $7.6 trillion of U.S. debt. That's 21%. So who holds the other 79%? Welcome to Histonix Drift. We follow the money, trace the power, and expose the history they never taught you in school. The remaining debt, the $27 trillion in U.S. obligations that doesn't show up in foreign central bank vaults, sits in 3 places. U.S. government accounts hold about $6.8 trillion. The Federal Reserve holds $5.2 trillion. American institutions, pension funds, insurance companies, mutual funds, banks hold the rest. The U.S. government owes money primarily to itself and to its own citizens' financial institutions. This isn't unique to America. Japan's government debt stands at 260% of GDP, the highest ratio in the developed world. Foreign entities hold less than 10% of Japanese government bonds. The Bank of Japan holds over 50%. Japanese banks, insurance companies, and pension funds hold most of the rest. The Japanese government owes money to Japan. Look at Britain. Foreign investors hold roughly 28% of UK gilts. British pension funds and insurance companies hold about 30%. The Bank of England holds another chunk through its quantitative easing program. The pattern repeats across every major economy. The debtor and the creditor occupy the same territory. Often, they're the same institution. This violates the fundamental logic of debt as you understand it. When you borrow money to buy a house, the bank becomes your creditor. The bank exists separately from you. The debt represents a transfer of purchasing power from the bank's balance sheet to yours, and you pay it back over time with interest. That's not what's happening at the national level. Nations aren't borrowing existing money from external creditors. They're doing something else entirely, something that was engineered into existence on August 15th, 1971, and something that tracks back through specific policy decisions to a conference room in Bretton, New Hampshire in July 1944. The creditor you're looking for isn't a person, a country, or even a collection of banks. The creditor is the system itself, and that system runs your life. July 1944. World War II still rages in the Pacific. Europe lies in ruins. Representatives from 44 nations gather at the Mount Washington Hotel in Bretton Woods, New Hampshire, to redesign the global financial system. The conference wasn't about peace. It was about architecture, monetary architecture. The 2 dominant figures were John Maynard Keynes, representing Britain, and Harry Dexter White, representing the United States. Keynes proposed an international clearing union with a neutral reserve currency he called the Bancor. No single nation would control it. Trade imbalances would automatically correct. White had a different vision. The US dollar would become the global reserve currency, backed by gold at $35 per ounce. Other currencies would peg to the dollar. The International Monetary Fund and World Bank would manage the system, but ultimate authority would rest with the country that held the most gold and the strongest economy. That country was the United States. White won. The Bretton Woods system locked the dollar into the center of global finance. If you were France and wanted to buy oil from Saudi Arabia, you needed dollars. If you were Japan and wanted to purchase American machinery, you needed dollars. The dollar became the universal translator of economic value. But this created a paradox that economist Robert Triffin identified in 1960. For the world to have enough dollars to conduct trade, the United States needed to run persistent deficits, sending more dollars abroad than it received. But running persistent deficits would eventually undermine confidence in the dollar's gold backing. The system required the U.S. to simultaneously maintain stability and create instability. By the late 1960s, the U.S. was hemorrhaging gold. Foreign central banks held more dollar claims than the U.S. had gold to redeem them. France, led by President Charles de Gaulle, began converting dollar reserves to gold, directly challenging American monetary authority. The advisors around President Richard Nixon saw the endgame approaching. On August 15, 1971, Nixon appeared on television and announced the U.S. would temporarily suspend the convertibility of dollars into gold. The announcement was framed as protecting American workers from international speculators. What it actually did was terminate the last link between major currencies and physical commodities. The temporary suspension became permanent. By 1973, major currencies floated against each other with no anchor to gold, silver, or anything except government decree. Money became pure fiat. It had value because governments said it had value and enforced that claim through legal tender laws and tax obligations. This shift changed what debt meant. Under a gold standard, government debt represented a claim on a fixed commodity. Bondholders could, theoretically, demand gold. That constraint limited how much debt a government could issue. The laws of physics constrained monetary policy. There was only so much gold. After 1971, government debt represented a claim on more government debt. Bondholders received dollars, which were themselves just different instruments of government obligation. The constraint became political and psychological rather than physical. This is the moment when the modern debt system was born. Not through legislation or public debate, but through executive decision during a Sunday evening television address. The Bretton Woods system had created a world where dollars were needed for international trade. The Nixon shock created a world where those dollars were backed by nothing except the requirement that you pay taxes in them and the fact that oil was priced in them. These two decisions, made by small groups of men in conference rooms, built the cage you live in. You probably learned in school that banks accept deposits and then lend those deposits to borrowers. Savers put money in. Borrowers take money out. The bank is an intermediary. That description is false. It's not a simplification. It's not close enough for practical purposes. It's simply wrong. In 2014, the Bank of England published a paper in its quarterly bulletin titled Money Creation in the Modern Economy. The paper was remarkable because it stated plainly what banking textbooks obscure. Banks do not lend existing money. When a bank makes a loan, it creates new money. Here's the actual mechanism. You walk into a bank and request a $300,000 mortgage. The bank doesn't check if it has $300,000 in its vault. It doesn't call other depositors to ask if it can lend their money. The bank simply types $300,000 into your account. That deposit appears. Simultaneously, the bank records your debt obligation, your promise to repay $300,000 plus interest. The loan creates the deposit. Your debt brings money into existence. This isn't fraud. It's how the system works. The bank now has an asset, your mortgage, and a liability, the deposit in your account. You have an asset, the deposit, and a liability, the mortgage. The money didn't exist before the loan. The loan summoned it into being. And when you spend that mortgage payment to buy a house, the seller receives the deposit. The money enters circulation. When you make monthly payments, you're destroying money. Each payment reduces both your debt and the deposit base. Money creation and money destruction happen continuously through the lending process. The limit on this process isn't the bank's existing deposits. The limits are regulatory capital requirements, profitable lending opportunities, and borrower creditworthiness. Now scale this mechanism to the national level. Governments don't borrow existing money from a fixed pool of savings. When the U.S. Treasury issues a bond, it creates a debt instrument. Primary dealers, large banks authorized to transact directly with the Treasury, purchase these bonds. Where do these banks get the money? They create it. The same way they create money for your mortgage. The banks credit the Treasury's account at the Federal Reserve. The Treasury now has deposits it can spend. The banks hold Treasury bonds as assets. New money has entered the system. The national debt increased, and so did the money supply. When the Federal Reserve wants to influence this process, it conducts open market operations. The Fed buys Treasury bonds from banks. The Fed credits the bank's reserve accounts. The banks now have more reserves and can create more loans. The Fed has expanded its balance sheet. It holds more Treasury bonds and has created more reserve balances. This is called debt monetization. The central bank purchases government debt with money it creates for that purpose. Between 2008 and 2022, the Federal Reserve's balance sheet expanded from $870 billion to $9 trillion. Most of that increase came from purchasing Treasury bonds and mortgage-backed securities. The Fed created trillions of dollars of reserves and used them to buy government debt. Who is the creditor when the government borrows from the central bank, which creates the money for the purchase, and which is itself a creature of the government? The question collapses into meaninglessness. There is no external creditor. The debt is the money. The money is the debt. This explains the paradox from Chapter 1. Global debt exceeds global wealth because debt isn't a claim on existing wealth. Debt is the process by which money, and therefore recorded wealth, comes into existence Every dollar in your bank account, every euro, every yen, originated as someone's debt, either government debt, corporate debt, or household debt. Money is loaned into existence. If all debt were paid off, the money supply would collapse to nearly zero. This system wasn't discovered, it was built, and it was built to serve specific interests. The debt money system creates a wealth extraction mechanism that operates independently of productivity, innovation, or value creation. It channels economic output toward creditors through a process that's automatic, invisible, and politically untouchable. Interest is the key. When money is created through debt, the principal is created, but the interest is not. If banks create $100 of new money through loans but require $105 to be repaid, where does the extra $5 come from? It must come from someone else's loan. The system requires perpetual expansion. New debt must constantly be created just to service existing debt. This isn't a bug, it's the engine. In 2023, the U.S. government paid $659 billion in interest on the national debt. That's more than the defense budget minus veteran benefits. It's more than the entire Medicaid budget. Where did that $659 billion go? It went to whoever holds treasury bonds, pension funds, insurance companies, foreign central banks, wealthy individuals, and increasingly to the Federal Reserve, which returns most of its profits to the Treasury, a circular flow that disguises the underlying mechanism. But focus on the non-government bondholders. They receive $659 billion annually for the service of having money, not for producing goods, not for innovation, not for labor, for owning financial assets. This is extraction. The system extracts wealth from the productive economy and redirects it to creditors through the mechanism of interest on debt that can never be collectively repaid. Scale this globally. The Bank for International Settlements estimates global debt service, the total interest and principal payments on all debt, exceeds $20 trillion annually. That's $20 trillion of economic output redirected from wages, investment, and consumption to debt service. The system concentrates wealth automatically. Those who already hold financial assets receive interest flows. Those flows allow them to purchase more assets. Asset prices rise. The wealthy get wealthier, not through effort, but through position in the debt hierarchy. The numbers prove it. In 1989, the top 1% of Americans held 23% of total wealth. By 2023, they held 32%. The bottom 50% held 3.6% in 1989 and 2.5% in 2023. Wealth flowed upward through the automatic mechanism of debt service and asset appreciation. Central banks accelerate this process. When the Federal Reserve purchases treasury bonds and mortgage-backed securities, it bids up the price of those assets. Who holds those assets? Primarily wealthy individuals and institutions. The asset price inflation creates wealth gains for those already wealthy. Between 2008 and 2021, the Fed's quantitative easing programs added roughly $15 trillion to U.S. household wealth. Approximately $13 trillion of that went to the top 10% of households. The bottom 50% received about $400 billion. This isn't conspiracy, it's mechanics. The system operates exactly as designed. Debt creates money. Interest extracts wealth. Central banks support asset prices. Wealth concentrates. The political system can't address this because the debt money mechanism exists upstream of politics. Politicians debate tax rates and spending priorities, downstream effects. They don't debate whether money should be created as debt. That question was settled in 1971, and settled before that at Bretton Woods, and settled before that through decades of banking evolution. You can vote for different parties. You can protest. You can demand change. None of it touches the core mechanism. The mechanism runs silently underneath every policy debate, every election, every reform. The cage is built from debt, and you were born inside it. The system feels permanent. It feels like the natural order of money. That feeling is the greatest trick the architects ever pulled. Debt-based fiat currency is an experiment, a recent one. For most of human history, money worked differently. The ancient Mesopotamian civilizations used commodity money, barley, silver, copper, with periodic debt jubilees. Every few decades, the king would declare a clean slate. Debts were canceled. Enslaved debtors were freed. Land returned to original owners. Why? Because Mesopotamian rulers understood that debt accumulation destabilizes societies. Debt compounds. Wealth concentrates. Eventually, too many people owe too much to too few. Social cohesion collapses. The solution was periodic reset. The Bible's book of Leviticus mandates a jubilee every 50 years. Same principle. Debt forgiveness as social technology. Rome operated differently. Rome allowed debt to compound without relief. By the late Republic, a tiny aristocracy controlled most wealth. The majority of Romans were debt peons or slaves. Political conflict became unsustainable. Civil wars erupted. The Republic collapsed into empire. Medieval Europe used multiple forms of money simultaneously. The Catholic Church banned usury, lending at interest. Monarchs issued tally sticks, notched pieces of wood that represented tax credits. Merchant cities developed bills of exchange. No single money system dominated. The Bank of England, founded in 1694, pioneered the model of government borrowing from a private central bank. The bank was chartered to lend money to the English government to finance war against France. In exchange, the bank received the right to issue banknotes backed by government debt. This was the prototype. Government debt became the backing for currency. The model spread. Central banks emerged across Europe in the 18th and 19th centuries, all following the same pattern: currency issuance based on government debt. But these currencies remained convertible to gold or silver. The commodity anchor limited expansion. Governments that printed too much faced immediate consequences. Bondholders could demand metal. The currency would collapse. The 20th century severed that anchor in stages. World War I forced European nations off the gold standard temporarily. The chaos of the 1920s and 1930s, hyperinflation in Germany, deflation in the US, demonstrated the gold standard's brittleness. Bretton Woods created a hybrid: gold backing for the dollar backing for other currencies. Nixon's 1971 decision completed the transformation. For the first time in history, the world's major currencies floated with no commodity backing at all. Pure fiat, pure debt. The experiment is 53 years old. That's one human lifespan. 3 generations have lived entirely within this system and mistake it for eternal. History shows what happens to debt-based fiat systems without reset mechanisms. They collapse, not through invasion or natural disaster, but through loss of confidence. The Mongol Yuan dynasty issued the first large-scale paper currency, the cow, beginning in 1260. The currency was backed by nothing except the authority of Kublai Khan. Refusing to accept it was punishable by death. For 90 years it worked. Marco Polo marveled at paper money's acceptance in his travels, but the Yuan government continually increased issuance to finance wars and construction projects. By the 1340s, hyperinflation had destroyed the currency's value. By 1368, the dynasty collapsed. The Ming dynasty that followed abandoned paper money entirely for over a century. Revolutionary France issued the assignat in 1790, a currency backed by confiscated church lands. Initial issuance was limited, but war and political pressure led to continual expansion. By 1796, the assignat was worthless. Napoleon restored hard currency. The Weimar Republic's hyperinflation in 1920s Germany followed the same pattern. The government printed marks to pay debts and finance spending. The currency collapsed. Social chaos followed. The resulting desperation created the conditions for fascism. Every historical example of unconstrained fiat currency ends the same way: overissuance, inflation, loss of confidence, collapse. The counterargument is that modern central banks are sophisticated. They understand monetary policy. They have models. They have credibility. But the debt continues to grow faster than the economy. The U.S. debt to GDP ratio was 35% in 1980. It's 123% in 2024. Japan's is 260%. The trajectory is exponential. The system stays functional as long as confidence holds, as long as bondholders believe they'll be repaid, as long as currency users believe the money will hold value. Confidence is psychological. It's not a law of physics. It's a collective belief, and collective beliefs can shatter. The system shows stress fractures, not theoretical problems, actual breaks in the machinery. In September 2019, the overnight lending market for bank reserves, the repo market, seized up. Interest rates that normally hovered around 2% spiked to 10%. Banks that needed short-term cash couldn't get it at any reasonable price. The Federal Reserve intervened within hours. It injected hundreds of billions of dollars into the repo market. The intervention continued for months. The official explanation was technical factors and quarter-end balance sheet pressures. The real explanation: major banks didn't trust each other's balance sheets enough to lend overnight. The foundation of the financial system, interbank trust, had cracked. March 2020 brought another crisis. As COVID-19 spread, Treasury bond markets, supposedly the safest, most liquid markets in the world, began to fail. Trading broke down. Dealers couldn't find buyers. Prices swung wildly. The Federal Reserve responded with the largest intervention in its history. It purchased $1.5 trillion of Treasury bonds in 3 weeks. It expanded its balance sheet by $3 trillion in 3 months. The intervention wasn't about COVID directly. It was about preventing a collapse in the market for government debt. If Treasury markets fail, the entire debt money system fails. The intervention worked. Markets stabilized, but the Fed's balance sheet never fully contracted. The money remained in the system. The precedent was set. Treasury markets are now explicitly backstopped by unlimited Fed intervention. This creates moral hazard at a systemic level. Bondholders know the Fed will intervene to prevent losses. That guarantee encourages more risk-taking and higher debt levels. The system becomes dependent on the backstop. Removing it triggers collapse. Maintaining it guarantees expansion. The trap is closing. Inflation returned in 2021-2023 after decades of relative stability. Official inflation rates reached 9% in the US, the highest since the early 1980s. European rates reached similar levels. Central banks raised interest rates aggressively to combat it. But higher interest rates create a new problem. Government debt becomes more expensive to service. The US paid $659 billion in interest in 2023. As older bonds mature and are replaced with new higher rate bonds, that number will rise. Estimates suggest interest costs could exceed $1 trillion annually by 2030. At that point, interest on the debt becomes the largest single budget item. It crowds out spending on everything else, and it accelerates. Higher interest costs require more borrowing. More borrowing increases the debt. Increased debt raises future interest costs. The spiral feeds itself. Japan offers a preview. The Bank of Japan has held interest rates at or near zero for over 20 years. It owns over 50% of all Japanese government bonds. It has directly monetized government debt on a scale no other major economy has attempted. The result is stability at the cost of growth. Japan's economy has barely expanded in 30 years. Asset prices remain below their 1989 peaks. The population ages. Debt compounds. Japan can sustain this because the debt is mostly held domestically and denominated in yen, a currency the Bank of Japan can create without limit. But the system requires perpetual intervention. The Bank of Japan can never truly exit. It's trapped in permanent crisis management mode. The US faces a different constraint. The dollar's reserve currency status means foreign entities hold significant dollar debt. If confidence in the dollar's value erodes, foreign holders can sell. That selling would spike interest rates and potentially trigger a currency crisis. The dollar's strength has protected the US from this scenario. But that strength comes from the lack of alternatives. The euro has its own problems. The yen is trapped in deflation. The yuan isn't freely convertible. The dollar is the cleanest dirty shirt. That's not the same as clean. The signs of stress are visible. Rising yields on long-term bonds despite Fed policy. Increasing volatility in currency markets. Growing divergence between official inflation statistics and lived experience of price increases. The system hasn't collapsed, but it's operating at the edge of its design parameters. Every crisis requires larger interventions. Every intervention creates new fragilities. The question isn't whether the system is sustainable long-term. History and mathematics both say it isn't. The question is, how much longer confidence holds? You are not a neutral observer of this system. You're inside it. The debt machine shapes every economic decision you make, and most of the non-economic ones. Your salary is denominated in currency that's someone else's debt. Your savings account holds bank deposits that represent the bank's liability to you, backed by loans the bank made to other borrowers. Your retirement account holds bonds, government and corporate debt, and stocks, whose value depends partly on corporate debt financing. You exist at a specific point in the debt hierarchy. That position determines your economic life. At the top sit the primary creditors, central banks, major commercial banks, sovereign wealth funds, pension funds managing trillions. These entities create money through lending or hold vast quantities of debt instruments. They receive interest flows. They benefit from asset price inflation. They have direct access to central bank liquidity. Below them sit secondary creditors and large asset holders. Individuals wealthy enough to hold significant bond portfolios, corporations with cash reserves, smaller financial institutions. They receive interest flows and capital gains, but lack direct access to money creation. Below them sit the productive economy, businesses that make goods and provide services, workers who exchange labor for wages. These participants create actual value, but must service debt to function. Businesses borrow to invest. Workers borrow to buy homes and education. The interest flows upward. At the bottom sit the debt peons, individuals with high-interest consumer debt, student loan borrowers, payday loan customers, subprime borrowers. They pay the highest interest rates and have the least access to credit. They're net payers into the system with little hope of becoming net receivers. Your position in this hierarchy determines your relationship to inflation. If you hold assets, real estate, stocks, bonds, inflation can benefit you. Asset prices often rise faster than the currency depreciates. Your debt becomes easier to service with inflated currency. If you hold only labor, inflation destroys you. Your wages lag price increases, your purchasing power erodes, you work more for less. The system transfers wealth from the bottom of the hierarchy to the top through the mechanism of interest and through inflation's uneven effects. You can see this in housing. In 1970, the median U.S. home price was $23,400. The median household income was $9,970. The home cost 2.4 times annual income. In 2024, the median home price is $417,000. The median household income is $74,580. The home costs 5.6 times annual income. Housing became more than twice as expensive relative to income. Why? Because housing is purchased with debt. As the debt money system expanded, credit became cheaper and more available. More credit chasing the same housing stock bid up prices. Asset owners benefited. First-time buyers faced higher barriers. The same pattern appears in education. In 1980, the average cost of tuition and fees at a public four-year university was $2,119. In 2024, it's $10,162, an increase of 403%. Median household income increased 143% in the same period. Education became more expensive because student loan availability increased. More credit chasing the same educational credentials bid up prices. Universities captured the loan money through tuition increases. Students graduated with debt. The debt machine inflates asset prices and increases the cost of leveraged purchases. Those who already own assets win. Those trying to acquire assets lose. Your position in the hierarchy is largely determined by your starting point. Inherited wealth provides access to assets and credit at favorable rates. Lack of wealth means starting in debt, paying higher interest rates, and climbing upward against a system designed to extract. The political options presented to you don't address this structure. You can vote for lower taxes or higher taxes, for more spending or less spending, for regulation or deregulation. None of these options question the debt money system itself. Both major U.S. political parties support deficit spending. Both support central bank independence. Both treat the national debt as a policy problem to be managed, not as the fundamental architecture of the monetary system. The system is bipartisan. It's older than current political alignments. It operates through institutions that transcend election cycles. Your actual options are limited. You can position yourself optimally within the hierarchy, acquire assets, minimize high-interest debt, gain financial literacy. That's personal optimization. But personal optimization doesn't change the system. For every person who climbs the hierarchy itself extracts from everyone below. The system requires the majority to be net debtors, so the minority can be net creditors. It requires asset prices to inflate, so current holders gain while new entrants struggle. It requires perpetual expansion, so interest on existing debt can be serviced. You can win within the game, but the game itself is rigged. The only historical exits from debt-based systems have been collapse, jubilee, or revolution. Collapse destroys wealth indiscriminately. Jubilee requires political will that doesn't currently exist. Revolution is unpredictable and often makes things worse. So the system continues. You service your debt. You watch asset prices rise beyond your reach. You hear politicians debate tax rates while the fundamental extraction mechanism runs silently beneath the conversation. The creditor, in the end, is not a person, it's the system. And the system owns everything, including the choices you think you have. You found Histonix drift. We connect the dots between ancient gold and modern debt, between old empires and new billionaires. Share this if someone needs to understand the machine they live inside. The algorithm rewards early engagement. Subscribe if you want the next breakdown of power structures hiding in plain sight. The debt isn't a problem to be solved. It's the design, and now you know who benefits from it.